All right, so last class we did some problems you won't see in real life. I won't give you any renewable term. I won't give you a level term with a single premium, but it's a good way to get started. And then we'll do some that are more likely. So the last class, let's see if the systems will let us in. All right, there we go. All right, so last class we did a level term, single premium, we're just getting started. So if you see, make sure you're real clear on this. If you see it's a 3-year level term, you're going to have 3 Ds in a numerator. All right, very straightforward. Three-year level term, there's 3 Ds. So if its issue age is 30, you're going to see D30, D31, D32. Since it's single premium, you only have one premium, L30. So your premium is going to be D30 times the face, divided by 1 plus the rate to the first, plus D31 times the face, divided by 1 plus the rate to the second, plus D32 times the face, divided by 1 plus the rate to the third. You're going to see that pattern over and over and over again. And you divide that by the premium here, you only have one premium payment, the L30 at the very beginning. And so we'll do D30 times the face, divided by 1 plus the rate raised to the 1, plus D31 times the face, divided by 1 plus the rate raised to the second, plus D32 times the face, divided by 1 plus the rate. Bill Gates, plus the rate, divided by 1 plus rate raised to the third. So there's our numerator. The denominator, we just need to divide by the number of premium payers, which is whole 30. And there's our premium, 4840. And I'll prove it to you mathematically, but so on the exam, I give you several problems, but most of them you're just going to write the formula without calculating. So this is exactly what you would write. When I say give me the formula but don't calculate, that's what I'm looking for. The D's and the face. If I give you the face, put 10,000 in there for the face. If I give you the rate, give me the rate. But I mean, essentially, you write out the D's. So the main point is, so if you were to do this on the exam, it would look like you just put the rate in there. You just do that all the way throughout. Because what I'm trying to say to you is, oh, something happened here. Or that last little part. Yeah, you don't have to do it to the rate to the 0 because that's just 1. So on the exam, you write that. The main thing is I don't want you doing calculations. I just want you to give me an exam. And secondly, I don't want you to have to go to the mortality table, get D30, D31, D32. You're just going to write the D's and L's. I'm just really looking to see if you get the formula down. Okay. So that's the key for the formula. If I ask just for the formula without the calculations. Now, if I'm asking for the calculation, you should still write that and then give me the calculation. Then I can see if it was just a math error or you just bad typo in the computer. So you'll get quite a bit of partial credit, maybe even full credit. If I can tell it was just, you just accidentally hit a 3 when you meant to hit a 2 or something. So always write out the formula, even if I'm asking you to give me a number. If all you give me is a number, 52.06, and the answer is 48.4, all I have is that, then you get no credit. Because I have no idea if it was a math error or not. I can't tell if it's a math error if you don't write out the formula. If you show me you know the formula, then I'll probably give you quite a bit of credit, maybe even 70, 80% credit, even if.
We don't want like just formula text.
Yeah, just write it out. Yeah, you won't have Excel or anything, so you're gonna just have to be. I haven't had any trouble with students not being able to finish it. There is one crazy problem. We'll do a few of those as practice for sure to get used to it. The first time we do one, you're gonna think this is crazy. There's no way. And after do a couple of them, 2 or 3 of them, you can see, yeah, it's not really that bad. The first class I did one of those crazy formulas, only one student got it right. Do you think it was an actuarial science major or a finance major? What do y'all think? The surprising answer is what? It was a finance major that got it right. So I was expecting an actuarial science major to get it right, but a finance major got the. I knew it. I remember she works for Citibank today. Just moved up really fast, so I was really surprised she got it, but it was a pretty rough question. But since I've been doing them and we got more examples, students are starting to see it's really not that difficult. When you see one, you know what I'm talking about. They're pretty crazy problems. All right, there's problem 2. So let's try problem 3. Hopefully you're in Excel and trying to keep up with me here. That you loaded the mortality table so you can watch me. So problem 3 is another one that won't be on the exam, but gets us set up. This is the last one we'll do that won't necessarily be on the exam, and then after that, they'll all be candidates for the exam. All right, so if you see whole life, just be real careful here. If you see whole life, the D's go to age 99. All right, so if the issue age is 30, you got to do D30, D31, D32, D33, all the way out to D99, which means I'm not going to give you a 30-year-old whole life. I'm going to give you a 96, 97-year-old. The other thing is, if it says ordinary, the L's also go to 99. What ordinary whole life means is you pay premiums until the very end, all the way up to age 99. All right. So ordinary whole life, you'll have every D there is, and you'll have every L that there is. All right. This case, it's not a ordinary whole life, it's a single premium whole life. If it's single premium, there'll only be one L. Okay. So don't come up me in an exam and says, how many premium payments are there? If it says ordinary whole life, there will be until you run out of L's. Right, so we need, in this case, it's age 97. So we need D97, D98, and D99. But it's only one premium, so we only need L97. So it's going to look exactly like that limit pay, that level term we just did. It's going to look exactly like that. The formula is going to be almost, it's going to be exactly the same. It's just we're going to be using different numbers for D's and L's. And our L97, not many of them left, but 626 of them are still left. I saw a guy, 103 years old, being interviewed. Old military guy, pretty interesting interview. I like what he said about life. They asked him, how do you describe life? He says, well, first you got to get used to it, then you enjoy it, then you celebrate it. And so y'all are kind of in the get used to it phase, which is kind of your 20s, and then you start enjoying it. But this group here, they're in the celebrate it. It's like there's not much more we can do other than just enjoy our memories, but that's the group we have here. Our face here is again 10,000, and our rate is 5%. So our premium is going to be D97 times the face divided by 1 plus 0.05 to the first plus D98 times the face divided by 1 plus 0.05 to the second plus D99 times 10,000 divided by 1 plus 0.05 to the third. There's our denominator. I'm a little bit sloppy on the parentheses. I'm not real picky on that, but be careful, try to make sure you got them lined up somewhat. And then all of that's going to be divided by L97. Now, what's going to be more expensive? The level term was 48 bucks. What do you think this one's going to be? Is it going to be 48 bucks? How many of these 626 people are going to die? I got an error right there, don't I? Sorry, that's not V97. Excuse me. That is L97. Sorry, that's 301. Got my D's wrong. So how many of these 626 people are going to die? 626 of them. So why do you think, without even doing the math, why do you think the premium's going to be, if you're going to pay a premium today, and every single person is going to get $10,000 in the next 3 years? What do you think that premium's going to be? It's going to be more than what? More than 9,500 bucks, right? Right. So everybody's going to get 10,000 bucks, and they're going to pay us once. Now, if they pay us 3 times, that changes it, but they only pay us once. So it's going to be a pretty huge number. So we get 301 times 10,000 divided by 1 plus the rate. Raise to the first plus D98 times 10,000 divided by 1 plus the rate. Raise to the second plus E99 times 10,000, 1 plus the rate, raise to the third. All of that divided by L97. I said over 9,500, it's not quite that much. So that 5% brings it down quite, I guess so, because the 5% is going to bring it down about 500 bucks a year. You pay about half of them the first year, but yeah, it spreads it out. But still, you're going to pay $9,211 to get 10,000 bucks. So what kind of return of that? The people who die the first year, what will they get? They'll make 9%. The people who die in the second year, they'll make 4.2%. The people who die in the last year, they make 2.8%. Everybody has a positive return. Sounds pretty good, right? You pay 9,200 bucks and you get $10,000 back. Sounds great. Your worst case is make 2.8%. You can't make as much as 8.56% if you die fast enough, or you won't make anything. Your family won't make that. All right, any questions on that one? We're still not doing one. We're going to see. So the next one will be one on the exam. But so we've got the numerator. The only thing we haven't done with the numerator is put any L's in the numerator. Now remember, in immediate annuities, they start paying you an amount for the rest of your life. In that case, you just substitute L's for D's. It's not all that different. Annuities look like life insurance. You just use L's instead of D's. So what we got to do now is figure out what to do with the denominator. Premium payment. So let's do problem 4. Now you notice here it says a 3-year level term, and I don't tell you anything about the premium payers. If it says 3-year level term, but I don't say anything about premium payments, you're going to have 3 D's in the numerator and 3 L's in the denominator. All right. So if it just says level term, if it's a single premium level term, which is, I don't think it exists, I have to tell you that. If it's a limit pay level term, which really doesn't exist either, so it's 10-year level term, if you only pay premiums for 4, I'd have to tell you that. But if it says 3-year level term, you have 3 D's in the numerator, 3 L's in the denominator. This is all right. So it's H50, so we need D50, D51, D52. So always remember level term, if it's 3-year level term, that's how many Ds you're going to have. And you're also going to have L50, L51, L52. Y'all can see why a lot of the problems I don't ask you to calculate the premium, because you'd be sitting there on your calculator all night long. So a good chunk of the problem, I was just saying, just write the formula. This is a good one to write the formula for. So we need our D50s. D's are in column D. That worked out really well. So D50s. 622, 673, 729, and then our L50. It's in column B. There's our L50, L51, L52. So our premium, we're going to take D50 times, and let's put the face in there. Well, I don't know why I did a $100,000 face. Our rate, 5%. So D50 times 100 divided by 1 plus 0.05 raised first. Exactly like we did before. D51 times 100,000 divided by 1 plus 0.05 raised to the second. Plus D52 times 100,000 divided by 1 plus 0.05 raised to the third. There's our numerator. Now tell me if you see a typo, because I don't want any typos. There's your numerator. And all you have to do to that is the denominator. L50. Now premiums are paid at the beginning of the year. Benefits are paid at the end of the year. So we don't really need to discount L52. You can take L52 divided by 1 plus the rate to the 0 power, well, that's 1. So we can leave that out. Plus L50. Y'all keep me honest here. L50 plus L51. Here we do discount. 1 plus the rate raised to the first plus L52 divided by 1 plus the rate raised to the second. Get really used to that format because you'll write it a few times on the exam. So you have 3 D's in the numerator, 3 L's in the denominator. And let me make it clear on the denominator. I use a different type of bracket. Oops, wrong place. So your numerator, denominator, I'm probably missing that parentheses somewhere. Does that feel comfortable, everybody? Because I can't tell from the facial expressions. So what have we done? We've taken discounted cash flows, put the mortality table on top of that. And then here, what we talked about before, you've done something here you've never done before in any other finance class where you're actually discounting something that's not a cash flow. So,
Should it be 0.05 or 0.5? For D52.
yeah, 0.05. And let me put the rates in the numerator. Yeah, there probably will be typos, so keep me honest. I would do them on purpose if you're paying attention, but I don't need to because I'm gonna do them whether I do them on purpose or not, so. See some. That's essentially in this formula is life actuarial pricing. This is what pricing is all about. They gotta figure if they believe these numbers, who's gonna die when, what interest rate will they make? If they know that, they know what premium to charge to cover the insurance claims. It's that straightforward. They put a little bit of extra into it just in case people die faster. Remember, there's also the loading, which is the expense on the profit side. Yeah, the actuaries I dealt with, it was amazing the data they had, where they could tell you how many people died versus what they expected, what their expenses were versus what they expected, what the investment portfolio made versus what they expected by issuance year. Not for all their products, but say the product we issued in 2022, this is how it's performing 3 years later. I mean, it was amazing to me, the data they collected. And I don't mean in the last 5 years, I mean in the 1980s when we had PCs that you couldn't use today. I mean, they'd be so pathetically weak. My first PC, my word, $2,000 PC, not in today's dollars and those dollars, so like $8,000 PC today. And my word, it's a horrible PC, but they were doing, actually somehow figured out how to do some really, really amazing analysis back then with weak computers. All right, so if the actual math, it's a little bit messy here, but D50 times 100,000 divided by 1 plus 5%. Base of the first plus D51 times 100,000 divided by 1 plus 5%. Base of the second. That's D52 times 100,000 divided by 1 plus the rate. Base of the third. So there's your denominator. Bill Gates will let me hit enter. I really don't see where I messed up, but yeah, I don't know why he thinks it's wrong. I'm pretty sure it's right, but close that one. Do I have a division sign up or something? I don't know. Y'all see what it is?
You might need one more far right side. Okay, B 127.
B 125 times
Yeah.
100,000.
B 125
You might need parentheses there.
right here.
I think it might just be the far right because you started with the parentheses on the left.
Yeah, so that should close it, and that one's black, so it should close it. But yeah, I don't know why Bill Gates. Okay, Bill Gates. Whatever. He won't even fix it for me either. So there's something in there. I don't see it because
I think it's for your B 129.
this one here.
Yeah, a little further down. Cut up before you hit the division part of it. After the B 124. So it's B 124 times B 129. You went up parentheses there.
Yeah, but I don't know why you would need one there.
No, or towards the middle. Yeah,
That one there.
yes.
Closing it for what? I mean, that's, yeah, I don't, yeah, okay, well, Bill Gates doesn't like it. All right, so I lost the whole thing. So anyway, I don't know how, you know what I can do is I can copy this one down. That should be it. So I don't know why it's doing that, but yeah, I could have sworn that looked correct, but anyway. So 123 times 100,000 divided by 1 plus the rate. The first 124. Yeah, that really looks the same to me, but anyway, I'm missing it. Right, so there's your numerator. We're going to divide that by L50 plus L51 divided by 1 plus the rate raised to the first plus L52 divided by 1 plus the rate. Let me see, second. Good. 674.12. Now, is that right? We can test it and see if it's right. And I'm going to show y'all how to test it. You won't be doing it on this problem, but you will be doing it on the endowment problem. So just give you some practice. Since Bill Gates was screaming at me, let's see if it was actually right. So let me walk you through this process because I think this really helps you understand. So at time 0, only 2 things happen at time 0. You're going to collect the premium and you're going to invest the premium at time 0. What's your premium going to be? It's going to be L50 times the premium. So L50 is 92,793 people, and we're going to collect 674.12 from each one of those. All right, and then we're going to invest that at 5%. All right. So remember, they pay the premium today. If we pay any death benefits, it won't happen until exactly 1 year from now. So we come to time 1. You can do these in the first 2 in different orders, but I'm going to say the portfolio matures. So we invested $62 billion or $62 million at 5%. So we'll take that 62 million times 1 plus the 5%. So at the end of the year, we'll have 65,680, and then we're going to collect. Well, actually, I guess the next thing that happens is we'll pay death benefits. Actually, all 3 of these happen at the exact same time. This is the D50s times 100,000 bucks. So we're going to pay D50 $100,000. We're going to pay out 62,600, and then we're going to collect a premium, L51s times the premium. So we're going to collect L51 times 674.20. That doesn't look right. Ah, I did the wrong one. I did D51. So L51 times premium. And then our ending balance to invest, it's just going to be the sum of those. So at the end of the purse, at the time 1, we're going to have 65,614 to reinvest for the next year. All right. Then we come to time 2, and you can essentially copy these down on the second year, the same thing. The maturity of the portfolio at 5%. So you take what you invested times 1 plus 5%. You're going to pay death claims, D51 times 100,000. So D51 times 100,000. And we're going to collect the premium. This is our last premium, L52 times the premium. L52 times the premium. And our ending balance, 63,000. Then we come to time 3. We can't just copy it down this time because we're not going to collect a premium this time, but we can copy the first two down. And how do you know you've done it right? Well, when this portfolio matures at the end of time 3, it better be a very, very round number. In fact, you should be able to calculate it in your mind. It should be 729 with a bunch of zeros after it. You did it right. But let's see. Let's see if I did it right. So you take the ending portfolio times 1 plus our rate. And it doesn't look like a round number, so I did something wrong. That's not good. And then our death benefits, D52 times 100,000. So yeah, I did something wrong. Don't know where. And my guess is there's a typo somewhere in the formula. Fortunately for you, I don't count off for typos, but I don't know where I've messed up in here. Somewhere in here, there's an error. Oh, it sure looks right to me. 23, 24, 25, 29, 29, 130, 130, 130, 1, 2, 3, 26, 27, 28. First to the second. Yeah, I don't see where the error is. So I made some mistake. I'll have to fix it for next class so you can see it. I figured out it's a parentheses issue, I'm pretty sure. So you know you've done it right if it balances out to 0 at the end. Now on the exam, it won't balance out to 0 because of rounding, because you're only going to have 2 cents. You have to go out more. So you can be off 30, 40 bucks. But obviously, anybody see where I did it wrong?
Yeah.
On the premium? On the premium? Yeah, I was having that problem before. There you go. Ah, good catch, Nathan. All right. See, I did that on purpose for the X-rays. Nathan came through. Yeah, you got to be really careful on the parentheses. But again, this is not how well can you handle a calculator. So if you have you have it down. Some students will spend a lot of extra time to try to get that to 0. You will not get it to 0. I wish you could take the exam on Excel, then you could get it to 0. But I don't want you going out 12 decimal places so you can get to 0. 2 decimal places is fine. So how far off can it be if I round this to 2 decimal places? You're off 74 bucks. So rounding will throw you off, some, and it can be off. I've seen it off by a few $100s. It depends on the product it is, right? So don't try to get it exactly right. All right. So you will do this on one problem, but not on this problem. But it's very similar to this product. You're gonna do it on a matured endowment. So we'll talk about it with the matured endowment. So here's where you start noticing that every product kind of looks alike. You just got to make sure you get the D's and the L's all lined up. So the next one is essentially, it is the exact same problem as the previous one, just different ages. So ordinary whole life, age 97, 98, 99, 100, you have 3 D's in the numerator, 3 L's in the denominator. It's going to look exactly like the problem we just did. The word ordinary just tells you that the premiums go until the end of the table. So if I copy all of this over, Just instead of D50, it's D97, D98, D99, instead of L50, it's L97, L98, L99. The face is 100,000. So all I gotta do is go find D97. And again, everybody is gonna die here. They're all gonna get 100,000 bucks. But don't say the premium's gonna be 90-something thousand, because you can get the premium 3 times. There's fewer people paying the premium each time. So it's gonna be much lower than 90-something, $92,000. But it's not gonna be radically lower, because every single person is gonna get paid. So here you can see the premium is $55,650. They should get the same return as we saw before. Oh, no, you get much higher return, excuse me. Yeah, you get much higher return. The people who die in the first year are gonna make a really high return. Why? Because they get 100,000 bucks, they only paid 55,000 in, so they get a massive return. People die in the next year actually lose money because they paid 110,000 bucks and only got 100,000. And the people who died at the end, they were really upset. They paid 160,000, 65,000 bucks and got $100,000 back. So yeah, take that back. So yeah, there's the formula. All we got to do is replace the 50 with the 97, the 51 with the 98, 52 with the 99, L97, L98. Everything else is exactly the same. If I did a limit pay whole life, then I'd have to tell you how many years I paid the premium. So if say ordinary, the L's go to 99. If I say limit pay, I have to tell you how many years I paid the premium. So if they only paid the premium for the first 2 years, you would take the L99 out at the end. Then the premium would be higher because you're only getting 2 premiums instead of 3. But it's hard for me to do too much with whole life because there's just so many numbers. Now, if I did whole life at age 50 or 40 or 30, you'll start noticing much, much smaller premiums. Like if I start a whole life at age 25, if I gave you the exam on Excel, you could do that because you could copy the formulas down in Excel, you'd have all the mortality numbers. So you could do that. So we could actually price a ordinary whole life policy off of this table. We might, if we have some time at the end, we might compare a whole life issued at age 25 to a 30-year term issued at age 25, just to see how much of a difference there is. The whole life's going to be more expensive, but it's not going to be so radical so as you might think. All right, so there's that term ordinary, real important term. So don't ask me how many premium payments are. The word ordinary tells you, just like 3-year level term, that tells you have 3 premium payments. So limit pay whole life, we can do it, but it's so simple. So it's the exact same problem we just did. We'll get B97. 98, L97, L98, but we don't need L99. So it's the same formula, except we take out this last premium payment. And the premium goes up quite a bit, 61,640 instead of 55,000. You might think, well, that's not much of a difference, but the reason for that is just there's only 111 people at the end to pay that last premium. So, you already paid 5/6 of the people a death benefit by the time that last group pays. They're going to be really upset, but they won't be as bad off as if it had been this one. They're better off than they were here because the people who made it to the end had to pay 165,000. Here they only have to pay 122,000. but you have more payers doing that higher premium. Right, so that's limit pay. I don't know if I'll give you that on exam. I can't remember how to do that, but really not much to it. Just have to make sure you adjust it. I'm sorry. Probably a spam call. All right. Now let's get really fancy. One of my favorite products. We'll be seeing this when we talk about the benefit of survivorship. This is the big math problem on the exam. This is one that takes the most time. Right, so it's a 3-year endowment life policy. So what is endowment life policy? So this is the product that IRS doesn't like, because it kind of implies you're buying life insurance in order to avoid taxes. So what an endowment life policy does is if you die, it pays the death benefit. And at the very end, you're alive, it pays you a benefit for being alive. So if you die, you get 10,000 bucks. If you live, you get 10,000 bucks. Which means how many of these people are going to get 10,000 bucks? Every single one. But remember, life insurance is tax-free. So what does this essentially do? You give your premium to the insurance company and they invest it. Very few people get the 10,000 for dying because not many people die. The people who live get their money back plus interest, and it's tax-free. And the IRS saying no, that's not life insurance. So it's an endowment. I'm going to show y'all later that endowments, even if the tax code charges for it, it's still can be a really good product. So here we're going to pay people if they die at D50, at 51, at 52, and then if they're alive at L53, we're also going to pay them. So we're going to pay 10,000 to the D50s, to the D51s, the D52s, and L53s. We can collect premiums from the L50s, L51s, and the L52s. All right, so let me get my D50s. I get my L50, L51, 52, 51, 52, 53, L54. So I put these all together because these are all going to be paid money, and these are all going to be paying us money. So our premiums can get really hard to get in here. So we're going to pay our D50s $10,000 divided by 1 plus 5% raise the first, plus D51 times 10,000 divided by 1 plus 5%. Zero, but right? Raise the second, plus D52 times 10,000 by 1 plus 0.05 to the third, plus L53 times 10,000. Here's where you got to be really careful. Divided by 1 plus 0.05 raised to the what? When do we pay these people? So if you died in age 50, that's 1 year from now. Age 51, that's 2 years from now. 52, that's 3 years from now. If you're alive at the beginning of age 53, we pay you. When is the beginning of age 53? At the end of age 53 would be 4. So what's the beginning of age 53?
3.
3, exactly. So actuary, I'll give actuaries credit this time. An actuary figure out a way to simplify this. How could you simplify this? Any guesses? Let's see if any actuaries in here. I could simplify this. All right, finance majors, we'll give a competition.
Portion.
I think you're thinking the right way. Well, can't quite square, but it is true that this times this, you
Yeah.
could take that outside of parentheses, right?
Yes.
And then what are you left on the inside? D52 and L53. Anybody know what D52 plus L53 is? 100% of what? The people alive at 53 plus the people who died at 52 equals what? L52. So what could you do? You could just take this out entirely and just add L52. So you're thinking about rate procedure. You can definitely bring out the 1 plus 0.5 to the third. And then you're left with D52 plus L53. That's just L52. So you could do that. That's what he did on the exam. Was like, wait, what did he do? And I was like, well, okay, that's right. I have to give him credit for it. So yeah, you can simplify it like that if you want to. I won't do it like that, but you can do that. Divide that. It's going to look exactly like we've seen before. L50 plus L51 divided by 1 plus 0.05 the first plus L52 divided by 1 plus 0.05 the second. All right. Long formula. Numerator, numerator and denominator. Hopefully I don't have any typos in there. If you'll see any, let me know, but you're close. So we're going to see later why I love endowments so much, especially when we get to the benefit survivorship. It's a product I try to get patented at USAA, but I didn't. But I think you're going to find it's a pretty impressive product. The actuaries tell me they didn't think they could sell it. That's not a good excuse for not offering something that's really good. But all right, so if we do all of this, and again, who knows what Bill Gates would let me get away with here. Where's my numerator? The numerator, hope I got all of that correct. And then divided by the denominator, which is the same as before. L50 plus L51 divided by 1 plus the rate is the first plus I don't know if that's the right premium. It doesn't look right. So I probably have an error somewhere. But we'll test it because this is on the exam what you have to do. So this is part you really got to understand this for the exam because a lot of students just leave it late because they're like, I can't do it. Let me double check through the formula. It looks good. That's what I'm seeing. That might be right, but yeah, it probably is. I was thinking 100,000, but it's only 10,000. All right, so what do you have to do on the exam? So you have to do what we did before. You have time 0. You're going to have time 1, time 2, and time 3. All right. Time 0, you're going to collect the premium and invest. Time 1, you're going to mature the portfolio, pay claims, collect the premium, and reinvest portfolio. And time one and time two are going to be the exact same things. And in time three, you're going to only do two things. It's just you're going to pay claims for death and claim for the living. So both the dead and the living get something at the end, and then you have your ending portfolio. If you did it right, it should be zero, but we'll see how close we can get. So this is the pattern you want. I want to get used to this pattern. I don't need these extra lines here, but you understand this, you understand what you're pricing. So we can collect a premium, which is our L50 times our premium. I'm not going to round the first time just so we can see if we can get it. We got just enough time to get this done. So there's our L50s times our premium. The portfolio matures at 5%. You're going to notice massive balances. And the reason you're going to have massive balances is not that many people are dying. So the first few years, you're collecting a lot of money. And then at the end, everybody that's alive is going to get money. So you're going to have this massive payout at the end. So you're going to pay claims or D50s times $10,000. So it looks like we're going to have too much money left over, but that's okay. I mean, unless it's really messed up the formula. Then we collect our premiums, L51 times the premium. And then we reinvest the portfolio. As the portfolio matures. Bill Gates is the most useless person. We're going to pay claims. There are D51s. Oh, D51s. And collect premiums from our L52s. This is our last premium that we collect. It's going to look massive. We're getting a lot of money here. And we reinvest that. So we got $1 billion left. And we're going to make 5% on that. Hopefully we have a round number. Drum roll. Nope, not a round number. So I did something wrong. I don't know what I did wrong this time. So we have our D52s times 10,000. And we got to pay our L53s times 10,000. So we paid essentially everybody. So we can get close. Yeah, I did make some major mistake somewhere. So we got to figure that out. Nathan's probably already figured it out, but there's probably some error somewhere in the formula here. You can see why I don't count off of math errors. It's just so many opportunities to get wrong. I'll sometimes get full credit to someone who's way off just because I can see they put one thing in the wrong place, but I don't see an obvious error in here. I'll figure it out before next class and I'll put it out there. All right, so next class, we'll finish up what we have left with the next class. I'll get this endowment to work so you can see where it is, so you can check your answer. Then I'm going to give you a few examples of these really complicated problems so you can see what they are. After we do 2 or 3 of them, you're going to find that they're not that difficult, even though, math errors are possible, but the actual problems themselves are not that. All right, so last class, I was struggling with this. I was off by parentheses. I don't remember where it was in here, but I had a parenthesis off somewhere. And I just don't know. I can't remember where. Somewhere in here, I had a parentheses off, somewhere like right there or something. But I had a parentheses off, but I found it. So be careful on the parentheses, but I don't count much off on that type of math error, but just be really careful. If you have the parentheses correct, we did the math last time. You collect the premium time 0, then you invest it, it matures a year later. You pay your death claims, you collect the next premium, you reinvest portfolio, it matures 5% higher, pay another claim, death claim, collect another premium. You have a massive portfolio at this time that matures at a massive number. You pay your D52s and L53s together, it comes out to 0. Now this one's probably going to round pretty well. You do it out 2 pennies. It's only off $56 because it was 47.95 something. It was really close to 48, so it's only off 56. But it could be off by quite a bit more than that. I don't know the max. Let's say if the rounding was off 40 cents. It could be quite a bit off. So what I'll try to do when I do the problem is I'll try to make sure rounding doesn't cause a massive issue. So I might change a couple of numbers to get it closer to that. This is a big problem on the exam from a time standpoint. It's not massive point wise. I think it's a 5-minute question out of 75 minutes, but it does take quite a bit of time. But it's a perfect question because it has both the death and life, and the numerator has a bunch of payments. So one thing I did up here is I did create 3 problems or 4 products. You won't do this on the exam because you have too many calculations, but I did a 10-year level term. Here's the present value of the death benefits. Here's the present value of the premium payers. So if you do 10 years of those, you get a premium per year. You're going to do it on a monthly basis. There's your premium. If you do a 20-year level term, it's $17 a month. 30-year, $23 a month, and then whole life, 56. So whole life's much more expensive, but the 10 versus the 20, it's only $3 more a month. The 20-year makes a lot of sense. The 30-year would make sense, but the industry stopped selling the 30 years, so you're kind of stuck with the 20. So 20 makes a lot of sense. But what are you doing? This is something, make sure you wear. This is what you're going to be buying probably the next few years. So you buy 20-year, you don't buy it and hold it for 20 years. So I would recommend at least every 5 years, go out and price it again. Because the way mortality tables have worked, it might be possible 5 years from now to buy a new 20-year policy and the premium might be $17.23. Well, obviously you buy the new policy, you save, 44 cents, but you pick up an extra 5 years. So with level term, you should always reshop it at least every 5 years. You don't want to go to the very, very end. If you're healthy in 5 years from now, you're probably going to do pretty well. You're probably going to be able to move it forward 5 years and it not cost you more than a few pennies more a month. And picking up that 5 years is huge, right? I mean, it gives you an extra 5 years. If you got sick 15 years from now, you just have another 5 years that cover you. So if you are healthy, consider buying a new 20-year level term at least every 5 years. It really, really does make a lot of sense. And it was when I was at USA, the mortality tables were coming down dramatically. People were living much longer, fewer smokers. Just people were much healthier. And you are seeing pretty dramatic drops, like $1 or $2 lower for the same policy. So you pick them an extra 5 years and you save a couple of dollars in premium. You might as well do that. It just makes a lot of sense. All right, any questions on that? I wish I could give you, I'll see what you could do if we had the entire mortality table in Excel. You could do a lot of problems. So let's do a crazy problem, all right? So you will get one crazy problem. I'm going to try to convince you it's not as hard as it looks. This is not the one in the notes. So one thing I'll warn you, one of the hardest ones I've ever given is the one that's in the notes. So let's not start with the one in the notes. Let's start with one a little easier. I want to give you some tricks on this. This is the Sincere Life Insurance Company. Guess when I wrote this? When Sincere was was our fullback for UTSA. I don't know if y'all remember him. We were talking about him not too long ago. Miles was his roommate, and Miles was a finance major, so I knew Miles. I didn't know Sincere, unfortunately. All right, so Sincere Life Insurance Company. It's issued for people aged 25. You pay a premium at age 25 and 26. So we have an L25, we have an L26. And they're going to pay the premium again at age 40 and age 41. If they are alive. So we only need the L40s. It doesn't, if people die after age 25, but before age 40, they don't have to pay the premium. It then pays a lump sum of anyone alive at the beginning of age 85, a lump sum of $5 million to anyone alive at age 90, and a lump sum of $10 million for anyone alive at age 95. The rate is 5%. So let's think about the ends on here. What time period are we going to use? And so here's a real simple thing. If it is at the beginning of the year, so that's anybody alive, it's at the beginning of the year, you just subtract. So for premium payers, 25 minus 25 is 0. 26 minus 25 is 1. 40 minus 25 is 15. 41 minus 25 is 16. 85 minus 25 is 60. 90 minus 25 is 65. And 95 minus 25 is 70. All right. So if you're doing anything at the beginning of the year, you're in for your discount. It's going to be just subtracted 2 years. All right. If it's a death benefit, guess what you have to do? It's at the end of the year. So if it were paid to people who die at age 95, what would your end be? Be 71. All right. So just if you have that down, these problems are really not that difficult. Because all you got to do is stick the L's, the payments in the numerator, the premiums in the denominator, divided by 1 by the rate raised to whatever the N is. If it's a life payment, people are alive, just subtract the L from the beginning period. If it's paid at the end of the year, subtract and add 1. All right. If you do that, you should get the right answer. So let's look at the denominator. So the first payment is $3 million for people alive at age 85. So we're going to take L85 times 3 million divided by 1 plus 0.05 raised to the what? So our starting year is 25. This is L25, so raised to the 60th. Everybody understand why I'm saying 60 and not 61? If it was a death benefit to people age 95, then it would be raised to the 61st. All right. So remember that this is not a difficult product. The second payment is $5 million to L90s. Divided by 1 plus 0.05. And here 90 minus 25 is 65. Plus the last one is the L95 times $10 million divided by 1 plus the rate raised to here 70. 95 minus 25 is 70. So there's your numerator. Numerator should be pretty simple. If it's a D or an L, subtract. If it's an L, just subtract. If it's a D, subtract and add 1. The ends are pretty straightforward. So any payouts, really simple. All right. Any concerns on that? All right. And what about the denominator? So the denominator, you have your L25s. We don't need to discount that. Plus your L26 divided by 1 plus 5% raised to the first. premiums are the same way as the numerator and denominator is the same. If it's the beginning of the year, and premiums are always beginning of the year, you just subtract. So pretty straightforward. The next premium you're gonna receive at L40. $40 minus 25 is 15. And then the next premium you're gonna receive at L41. Raise 41 minus 50 minus 25 is 16. And there's your denominator. Very, very simple, very straightforward. Why'd I do these crazy products? Just to see that you understand how to use the mortality table. Now you might say, wow, this being an expensive product. You're gonna get $3 million. You could get as much as $18 million. And you're only gonna pay 4 premiums. If you only have to pay 4 premiums, this must be a really, really expensive product. How much would you pay 4 times to get $18 million in your life? What's the problem with you getting this 18 million? You got to live a really long time. So we're going to talk about the benefit survivorship. These products look really cheap once you realize that the probability of getting the money is really low. So let's do this. I don't know if I can get it to work, but we will check it. So let's get the numbers over here. There's our N. So L25 is the 100,000. L26 is the next one down. L40, 97,043. So that's the advantage this product has. It's paying out a lot, but they got a lot of people paying premiums that won't receive any of this money. So L85s, how many people we lost when we go out to L85? We're down to only 18,000. L90s, we're hardly anybody's left. Only 6,000 people are left. L95, man, it's just like pretty slim pickings. So we'll see if I can get it right. L85 times 3 million divided by, I'll be real careful, 1 plus the rate raised to the 60th plus L90 times $5 million divided by 1 plus the rate raised to the, 90 minus 25, so 65 plus L95 times 10 million divided by 1 plus the rate raised here to the 70th. So there's that's the present value what we have to pay out. Looks like a massive number, $4 billion, but we have 339,000 people paying a premium. So when we figure out the premium, we've got L25 plus L26 divided by 1 plus the rate plus L40 divided by 1 plus the rate raised to the 15 plus L41 divided by 1 plus the rate raised to the 16th. What's the chances you think I got this right the first try after last class? Some of y'all are doing what? Were y'all talking sports, not betting, but whatever. So 16,000 bucks. You pay 16,000 bucks 4 times, or 67,000 bucks, and all you got to do to get $18 million is pay 67,000 bucks and then live to be 95, and you get 18 million bucks. Sounds pretty good. Let's see if it works. So we'll try it out. You don't get to do this on the exam, but let's do your age. We'll start at age 25. We'll do our beginning balance. We'll do any premiums, payments, interest, ending balance. All right, so our beginning balance is 0. We're going to receive premiums of L25 times 16,000. It's going to be a huge premium. We're not going to pay anything out. Interest, remember, the interest is paid on what you earn, but you get the premium at the beginning of the year, so you will earn interest on this. So you'll earn interest on your beginning balance plus your premiums, but you don't lose any interest on your payments because they are going to happen if they're death benefits at the end of the year. Now, later on, our payments will be at the beginning of the year. So in this case, the payments will come out, but there's just none there. Times our rate. We just sum that across. There's our ending balance. And the next age is 26. Our beginning balance is our previous ending balance. We do receive a premium again. We receive L26 times the 16,000. We don't pay anything. Our interest, again, is going to begin our beginning balance plus our premiums minus our payments. In this case, we're subtracting the payments because they're happening at the beginning of the year. If they're death benefits, we wouldn't subtract the payments because they're at the end of the year. So you don't earn any interest and something happens at the end of the year. We multiply that by our rate. They give us this ending balance. And you notice this thing's going to build up pretty dramatically. We can go until we get to age 40. And what happens at age 40? We're going to receive a new premium, right? At the beginning of age 40. Our L40s times our premium. Still no payments. There's our interest. Not sure what happened here. So let me lock in this rate. I'd really love to talk to people at Zoom. That some key besides the escape key would be really nice. All right, so we just keep earning interest, right? So interest is a huge part. I was listening to the Corporate Finance Institute. They have, I'm doing their FMVA just to see what it's like because I'm recommending it to our freshmen to do it. They have one whole session on valuing banks, and it's interesting. They talk about banks and insurance companies. It's so different than other institutions. And one of the reasons is debt and financing is part of their operations. It's just integral. So, you know, most firms say, well, we're borrowing money or whatever, but insurance companies and banks, this is just part of their business. So this is just integral. So age 40, what was the next age? 41, right? So we go over the L41 times our rate. And that's our last premium. And now we've got $10 billion sitting aside. Wow, that sounds really good. Get to age 42. And that will go all the way out to age 85, right? So what happens at age 85? At age 85, we're going to pay to age 85 people $3 million. And that's in our sum, right? Because we're going to pay this at the beginning of the year, so we need to subtract it out. We earn interest on that. Oh, I made one error. I subtracted it. I'll add it because I'm going to do it as a negative number. So, so that's going to reduce our interest quite a bit because we're paying out 54 million bucks. We can't earn interest on that, so we're actually earning interest on 89 million, or 89 billion minus 54 billion. And so there we have that year. That's going to go until age 90. at age 90. We're gonna pay the L90s $5 million. So we only have 12 billion left. It's looking pretty good. I don't know. I didn't hear my odds of getting it right. Did y'all rookies, y'all give me any odds? My odds would be increasing right now, wouldn't they? Let's see. I mean, what gives you great hope that it might be correct? That it's such a round number, right? And since it's that beginning number, it needs to be a round number. When we're with the death benefits, it wasn't a round number until the year later. But here, since we're paying at the beginning of the year, let's see. It looks really good to me. There it is. Bill Gates doesn't think it rounds to zero, but it really, really does. He just doesn't know how to round correctly. So it works. Wouldn't you love to be on the exam, be able to test it? In fact, if I gave you this in Excel, I would have you actually build a schedule to prove that it's right. Now, that might actually help you with the question because then you see you did something wrong, you can go back and fix it. But it's not that difficult. Now, you must say, what a crazy product. I actually like this product. We'll see when we talk about the product I want to offer. It doesn't quite look like this, but with very, very small premium, you can pay people a lot of money if you go out far enough in mortality table. And I wish the life insurance company would sell products like this because people who are worried about running out of money at age 90, might be nice if $5 million show up at age 90. Yet they have to risk losing 100% of this times 4. So they may make a $67,000 investment and they're going to lose 100%. But if they lived to 90, who else in the world can you invest $67,000 in order to get a $10 million payoff guaranteed? There's not too many places, right? I can't give you the return on that, but I mean, I can give you a simple return. It's a pretty high return. We do it off of the last year. Well, let's just do the whole thing. 70, 25, 65 years. Yeah, it doesn't look good if I do it like that, but it's a massive return. It's if I do it off the entire time because that doesn't really count for the time difference, but it's huge. We'll look at it. I'll give you actually terms when we do benefit of survivorship.
What type of guarantees are there that, these life insurance companies are actually gonna?
Well, the nice thing is, if they don't survive, they're guaranteed by the state. So you've got like 300,000. Now these may be a problem because the states will only guarantee like 300,000. So yeah, you do have some issue with that. So you would want to have a very, very safe company. But yeah, I mean, you do have some FDIs, these like insurance.
So it would be a fraction of it.
Yeah, yeah, it definitely could be an issue. All right. So that's one of those type of products. I'll give you another one. I think I'll wait till Tuesday, give you a couple more so you can kind of practice it. I can't remember if I put another one out there. I can look real quick. I might have done another one with my last life insurance class. Let's see. Yeah, here's one. Let's do one more. Get some practice. I'm trying to get to the point where the entire class gets it right. It'd make me really, really happy. Or Ewers, I don't remember who Ewers is. Oh, that's at UT Austin's football cap. quarterback, wasn't it?
Mhm.
So I use a lot of sports people. All right. I might use the I forget the UTSA basketball star. Oh, what is his name? He texted me just not too long ago. Oh, anybody remember his name? He was playing for Chicago Bulls. Scored like 31 points. I can never remember. He has an unusual name, but anyway. I joked on Facebook that it's been like 62 years since the last time an NBA player texted me. That was the first time. But anyway, so I'll probably name our next company after him if I can remember his name. All right. Uber's life insurance company. They have this new product. All right, so this one has life and death in it. So you have to kind of be careful when you need to add the one. So the Uber's developed a new annuity product. It's issued to people age 30 who pay a premium at beginning of age 30, age 40, age 50. If I were you, I would just start writing down what do you need. It then pays a lump sum to anyone alive at age 85. They're going to, so if you pay the premiums, you're still alive at 85, you get 5 million bucks. It gives a lump sum of $10 million to anyone alive at age 90. And it gives a death benefit at the very, very end. Whoever dies at the end. So essentially they're saying, if you're alive at 90, you'll get 15 million bucks. But if you die anywhere between age 90 and 99, you're not getting anything. If you can make it to your 99th, then you're getting one last payment, and that's 15 million bucks. So we're talking about giving these people 30 million bucks. And they only have to pay 3 premiums, plus we're going to give them $5 million back at age 85. Now, this is why the one in your notes is really confusing. I did one where I said at age 85, I don't know where I did, but at age 85, they get all the premiums back that they paid ages 30, 40, and 50. That gets really complicated, so I probably won't do something that complicated. So what are our ends here? Well, 30. This is a premium payment. So y'all tell me. Let's see if anyone's paying attention. Is a premium payment beginning of the year? What's your end's going to be here? 10. What's your end there? What's your end here? 55. You're in there. Someone say it. I hear it. Say it loud. Confidence. Say it. You say it, Dion? 60. All right. And then the only one you have to be careful on is this one. What is this one?
7.
70. Very good. All right. Dion's got it. All right. So yeah, as long as when you see a D, I'm not going to give you an L that pays at the end of the life because that makes sense because some of them are going to be debts. So L's are always beginning of the year. D's are always at the end of the year. All right. And then our rate is here 4%. I don't know why I switched to 4. So there's our ends. Let's go get our numbers. L30 is 99,141. L40, 97,043. L50, 92,973. L85, 90. And then for those people who just live way too long, we're going to give them a huge bonus. Because if they made it to 99, they could make it to 105, 106, who knows what. So, you know, they could just forever and ever. So we're going to do, so L85s are going to get $5 million divided by 1 plus the rate raised to the 55. plus L90s times $10 million divided by 1 plus the rate raised to the 60. So L85, L90, and then D99 times 15 million divided by 1 plus the rate. And here, we're not raising it to the 69th, but the 70th. So 99 minus 30 is 69 plus 1. So there's our numerator. I hope I did it right. I don't like all those parentheses I put at the end. That may be right. So let's see, that first one closes out. That one closes out. Yeah, that looks right to me. And we're going to divide that. The premium payers is the easiest one. So we have L30 plus L40 divided by 1 plus the rate raised to the 10 plus L50. Oops, I'll fix that. That's not gonna work too well. Okay, L50 divided by 1 plus the rate raised to the 20th. That looks right. It's your premium. That looks kind of high, but we'll see. We'll work on it. I don't know if y'all are trying to do this on your Excel or your calculator. Does anyone sees them out there? Let me know. The one I had problem with, it was one of these parentheses before the raised to the power of. But I think I got them all this time. We'll try it. So we'll see what we can get. Paid 3 premiums of $81,000. It's about $240,000 for the ability to make 30 million bucks later in life. I don't know why I got a value here. Something went, so I'll just. What did we do wrong here? 38, C238, 241. C238. Yeah, I don't know what I did wrong there. That's strange. All right, so I messed this thing up, but that's probably 0. Yeah, it's still okay. All right. Let me move this one over. So we'll do age. Here we're starting at age 30. You got your beginning balance. You got your premium payment. You have your life benefit, your death benefit, you have your interest, and your beginning balance. So this you don't get to do an exam, but so you start off with 0. Your first premium is going to be L30 times 81,561. No life benefits, no death benefits. Your interest is going to be, we're going to sum the beginning balance, the premium payment, and the life benefit, but not the death benefit, because that's at the end of the year, times our interest rate. And our ending balance is just sum cross. We don't need decimals, I don't think. And we're going to lock in this interest rate. So beginning balance is that. No premium payments. No life benefits, no death benefits, and our interest Should be fine. There's our ending balance. Go out to age 40, and age 40, we get another premium payment. No benefits, some interest. That goes to age 50. Get another benefit, another premium. That's going to go to age 80. So what happens at age 80? We pay the livers, right? So here we're going to do minus, not 80. I get that right, wrong, didn't I? It's 85, isn't it? Is it 85 or 80? 85. So at 85, we're going to get the livers times, what do we pay them? $5 million bucks? So that's going to drop us down pretty dramatically. We're going to do that again for age, I think age 90 or not. What was the next one? 90. Times, what do we pay them? 10 million. We still got a little bit of money left. We don't need much because there's not many people alive. Go all the way out to the end. So here we're going to take the D99s. Did it look like it was right? I didn't look at the number. Looks pretty close, doesn't it? Here, it's not a round number, but that's okay. Why? Because we got to earn interest on the beginning balance because we're paying this at the end of the year. We earn just enough interest, and we added it to that. We got exactly 166. So what if you could check it on Excel and your Excel gave you a 0 in this last box? How confident would you be? You did the problem right. You'd be pretty confident, wouldn't you? Now, what could some people do? Well, you could do solver, right? And just have the premium here and have solver figure it out so that last one's a 0, right? That could be kind of cheating using our goal seek. Use goal seek, so you could do it like that. But you have to show your work. That's a pretty hefty premium. I'm going to show you some that aren't quite so extreme, but still, you spend $81,000 3 times for the option of making 30 million bucks. It's not too bad a return. If this person's going to be desolate, if they make it to 100 years old, but then $15 million shows up at age 99, if they die, I guess they're dying. So this is their family really happy. But we'll see. We'll do some scenarios where you can see this benefit survivorship is really powerful. So we'll do a couple more of these maybe next week to use in practice. And then before the exam, we'll work some of the problems from the last exam so you can really see what the exam format looks like. But you're kind of getting used to it, right? It's not that complicated to do a premium. All right. So here's the unusual product. I won't do this one today, but this one's a lot harder than what I gave on the exam. It's issued to pay people age 60 who pay $4,950. Then in 97, it pays an equal installment of 1.7 million beginning of each year and change of charges an annual premium at the beginning of each year. If they're still alive, you're supposed to calculate that premium. This one is just really difficult. And there's one other one where I say it charges a premium up front and then it repays that premium at some future time. And so those I won't get quite that crazy. I do have the answer to that one here, so you can look at it, but this one's a little bit more complicated to come up with. And it doesn't really make sense because you're paying them 1.7 million at the same time they're paying you a premium. So it's just too bizarre of a product. So I don't like this one, so we'll skip through this one. All right, so we've done all the normal products. We've done the one unusual product. Now what we want to do is this one, which I really like this one a lot. This is a joint life. So this is joint life. I'm only doing it for 1 year. I think you could probably do this if I did multiple years, but it can get pretty complicated. So it's first to die. So once someone dies, it pays. It doesn't pay twice if they both die at the same time. It doesn't pay twice if one dies on the first day of the year and one dies later. So it only pays when the first person dies. It doesn't matter which one dies, it pays. All right. So you have a few choices. Both live, both die, one lives, one dies, one dies, one lives. Those are your 4 choices, right? This policy pays if both people die, it's going to pay 10,000 bucks. If one lives and one dies, it pays 10,000 bucks. If one dies and one lives, it pays 10,000 bucks. What happens if they both live? Pays 0. All right. So you could do this product by calculating these 3 probabilities, or what could you do? You could calculate this probability and subtract it from 1, and that would tell you what? The probability of these other 3 happen. Which would we rather do? 3 probabilities or 1 probability? I'd rather do 1, all right? So the probability of living, remember the probability of living is L71 divided by L70 for the first person times L91 divided by L90 for the second person. The people alive at age 71 divided by the people alive at age 70, that's the probability the 70-year-old lives. Everybody agree with that? That seems pretty logical, doesn't it? The people alive at 91 divided by the people alive at 90, that's the probability of the 90-year-old living. We multiply those by each other. This is the joint probability as long as what? Their 2 lives aren't correlated in some way. We're ignoring correlation between the lives just to keep the product simple. So let's do L70, L71, L90, L91. So you need to collect those. There's L70, L71, L90, L91. So take this one, L71 divided by L70 times L91 divided by L90. So the probability they both live is 74.75%. All right. What's the probability one or both die? 1 minus that. All right, so that's pretty straightforward. Now here, it gets a little bit tricky here. You've got a 25% chance of paying out 10,000 bucks, and you're making 5%. So in this case, all you got to do is take the probability both die. Let me show you let me do it first. Times 10,000 divided by 1 plus the rate. Raise the first. That's going to be your premium. So that's going to be your premium. Now you're probably wondering, where are the premium payers? Well, we already consider that because we've been dividing by L. The L's already in here. We already have that. So you just kind of trust me. We don't need to divide by the premium payers because we're only going out 1 year. We took consideration of that when we divided by all the L's in here, so that the L70s are in these formulas already. If you don't believe me, you just have to know this formula. The probability that one or both die, that 25% times the face divided by the rate, rates of the first. So we don't have to have any livers in the denominator because we already took care of them up there. So you're gonna charge $2,404.88. Okay. Now, where does this product get complicated on the exam? Is what I want you to do is compare this to buying two term policies. So if you buy two term policy, what happens? If they both live, you get nothing. If one lives and the other dies, you get 10,000. If one dies, the other lives, you get 10,000. What if they both die? What do you get? You get 20,000. So there's a slight difference in these two policies, right? So buying two term policies is more beneficial in the probability that they both die. All right. Let's do the premium. So the premium for the 70-year-old, what is that going to be? Where we're going to take D70 and L70. So remember, you take D70. You already have L70. So you take D70 times $10,000 divided by 1.04. You divide that by the premium. So that's $380. That's our standard formula. You take the D70 times the face divided by 1.04, divide all by the premium. I mean, by the livers. Then you do D90 and L90. We already have L90 over here. We just need D90. And so our premium there is going to be the number of people dying times 10,000 divided by 1.04 divided by the livers. Your total premium for two policies is going to be 25,1227. So these formulas are the same formulas we've been using. Joint life we saw was 2404.88. The difference was 107.39. How can we prove that difference? What's that difference going to be? It's going to be probability both die times the face divided by 1 plus the rate. That should be the difference. If I did this right, that should be the difference. So let's try that. What's the probability both die? That's going to be D70 divided by L70 times D90 divided by L90, right? D70 divided by L70 is the probability a 70-year-old dies. D90 divided by L90 is probably 90-year-old dies. That's probably they both die. In that case, they'll get an extra 10,000 bucks. So let's try that. It's the probability they both die, which is pretty low. Take that times 10,000 divided by 1 plus the rate. And drum roll. Oh, I didn't do it right. So, wait. All right, so we'll have to figure out where I messed up here again, somewhere in here. I'll figure it out before next class. But that is the math. I'm sure somewhere in here I picked up the wrong number. So what's the key here? The key here is buying a joint life compared to buying the two term policies, the difference is pretty sizable here, whether it's 107.39 or 88.27. I'll figure out where I have the math there, but the difference is pretty sizable. For older people, the joint life saves quite a bit of money. So what I want you to understand, you'll see on the exam how I ask it. Why is this? Because the probability of die is significantly higher than 0. Here it's almost 1% chance. For younger people, the joint life saves almost nothing. Pennies. Why? Because the probability of die is practically 0. I can't spell practically. Is essentially, I think I can do essentially 0. So for older people, should they buy the joint life or the two terms? If they're buying the insurance to cover burial expenses or whatever, if they don't need, if they don't care if one or both dies, then they should just buy the joint life and save $100. There may be a scenario where both of them dying causes some kind of complete turmoil to the family and they would like the extra, so maybe they would. For most people, once you get past age 60, the joint life will save you, 3, 4, 5% or something. For younger people, it almost never makes sense to buy joint life because it just doesn't save you anything. You might as well buy the two term policies, pay the extra penny. We're talking about annual, so you save 3 pennies, you divide that by 12 months, you're just not going to notice it. So for older people, a joint life might make sense because there's a chance it's going to save you quite a bit of money. For younger people, it just never makes sense. And then anybody figure out my math error here? I know my spelling errors pretty bad. I wonder if I used 5% by accident in one of these. Or type 1,000 instead of 10,000. 104. 4. Yeah, I don't know where I did cut it wrong. But I'll prove it to you. I'll show it to you. All right, so there's a joint life. We'll practice a little bit more on that when we practice for the exam. But the key is get the premium. The premium is pretty straightforward. You figure out the probability they both live. 1 minus that's the probability that one or both die. That probability times the face divided by 1 plus the rate gives you the premium. So it's a fairly straightforward premium. I think I saw it. Is it 5% or 4%? Was I using 5%? Yeah, okay. Maybe that will fix it. Think that'll fix it? Could it be that simple? Getting closer. Look at there. Okay. So good. Who's y'all saw that? Y'all see what I was going? Yeah. That's why I shouldn't switch from 5%. I should use 5 the whole exam, so I don't. All right. So I actually want you to do this on the exam. You don't lose massive points if you can't, but it's not that I want you to be able to prove life to some friend. This just shows that you understand how the mortality table works and how discounted cash flows work. I'll try to use 5% all the way throughout the entire exam. So the only difference between the joint life and buying two term policies is when they both die. The two term policies give you twice as much money. That difference is entirely dependent on when they the probability of them both dying. For young people, I could do one for a younger person. Yeah, we'll try it maybe next class. I can show with a young person that there's almost no premium difference at all. And you look at a 25-year-old or 27-year-old, whatever, I mean, the probability they both die, it's essentially this times $10,000 divided by 1.05. So it's 3 cents a year. Or if it was a $100,000 policy, it would be 30 cents a year. Say, oh man, let's buy the joint policy. We can save 4 cents a month. Most people are going to think that way. Just buy the 2-term policies. Keep it simple. All right, let me say this. I will put this file out there eventually. All right, so there's your joint life. You can see here, there's no L in the numerator. If that confuses you, the L's are right there. So we took care of the premium payers right there. So you don't need it in the denominator if that's throwing you off. All right, so annual joint life pays to the first to die. So, and when does it make sense? It makes sense when there's a significant portion, probably they both could die at the same time. When that's the case, the joint life can save you some money. Otherwise, just buy the 2-term policies. Now, joint life can create issues if it's first to die, because sometimes we don't know who died first. You might say, who cares, because they have the same kids, but there's a lot of husbands and wives who have combined families where they have their kids and the other spouse has their kids. And the first to die, the husband, the money actually goes to a different set of beneficiaries. So it can get complicated. You might say, well, if the husband dies first and the life insurance goes to the wife, but if the husband dies and 2 seconds later the wife dies, so it's not going to go to the wife, it's going to go to the heirs. It's going to get really, really complicated. So they do have to try to figure out in auto accident who died first between the two of them, or if they died at the exact same time, who knows. It can create legal battles. If they both have the same children, there's no debate on that. It's not a big issue, but if there's different groups that benefit depending on who died first, it can be huge. There's probably something in the life insurance policy that kind of addresses that. All right, so I've talked about this. Younger people should just buy the 2-term policies. The older people, it kind of depends. How much do you save? But if you're saving more, that's because the probability you both die is pretty high. So you have to kind of ask, why are you buying insurance? Do you really care if one dies or both dies? If you don't care, then just buy the one joint policy. You don't really benefit from doubling up if you both die, kind of thing, so you kind of ask those questions. All right, here's an article. It's 10 years old, but I've seen some other articles on this. Women live longer than men, but men are closing the gap. Although I think the last few years, men have started losing ground again. Women do live longer, and the gap has been shrinking in rich countries. In England and Wales, the biggest peacetime difference between the sexes was 6.3 years. It's now only 4.1 years, and it's falling. In the early 1980s, women who made it to 65, traditional age retirement, could expect to live 4 years longer. The gap now is less than 3 years, so men are catching up. Why? This article talks about a little bit. Here's the gap. This is the gap between men and women, so the scale is not all that wide. The trend is superimposed on another, the life expectancy in most. So we're all living longer, but men are catching up on the women little by little. Half the difference can be explained by smoking. It's not that men are quitting smoking more than women, but it's just that men smoke more than women and they've cut back more. But men are much more likely to be smokers than women, but they also been more likely to give up cigarettes. A fifth of the longevity gap is explained by alcohol. The gap is widening. Men died from alcohol-related causes for every woman succumbs, so some of it is getting worse. Obesity, who knows what these new drugs are going to do. We know that the weight loss drugs are probably worse for women than for men because of the impact on lean mass. And so osteoporosis, whatever, I can say that word. But bone density is a huge issue for women. We'll see. This might all switch again in the next few years. So there are natural things in the woman's body that men don't have that give them longevity. More testosterone makes us do stupid things. Suicide is an issue in this. And there's actually a longevity science panel. I don't know if y'all knew that. I see the guys on TikTok talking about longevity all the time. So there's a lot of people talking about this. But there is a longevity science panel, and maybe several years old, but you guys don't watch that kind of stuff, but I'm 63, so I do. I'm kind of curious. One guy claims it's all about strength. So how long can you hang? And I do pull-ups every day, but I never have just hung like this for 2 minutes. I don't know how long I could go. Could y'all do 2 minutes hanging? Have y'all tried that? I know you could. You could probably do it with one finger in one hand. But yeah, I mean, it's like, strength is really, really important, but upper body strength is important as well. How do you improve your longevity? You start doing it in your 20s and 30s. You don't start doing it in your 70s. But yeah, that's huge. Strength is pretty, I don't know if this kind of is related to it, is hand grip, how strong your handshake is. There's a relationship between that and your longevity. So a simple way to assess how likely someone is to die in the next few years is to test the strength of their grip. That's probably very related to that strength as well. The average grip strength was 300 newtons, whatever that is. Every 50 newton drop below this associated 16% risk of death, 17% for heart disease, 7% greater risk, a heart attack, 9% chance of a stroke. And there's it's impossible to know whether muscular weakness is causing the illness or is a symptom that matters. So we don't know if you started really using a really strong grip, doesn't mean you're going to live longer. It's probably you have a strong grip because you just have more muscles. So muscle strength is really important in longevity. What I find interesting isn't longevity, but the high relationship between muscle strength and dementia. I'm far more interested. I'm not trying to live as long as I can with dementia. I'm trying to live as long as I can with good mental faculties. So there's a strong relationship between strength and reducing the risk of dementia. That to me is far, far more important. But anyways, get to the gym, start working out, lifting weights, whatever. Tell students, don't sit at a desk. Just don't do it. Have a weight going there. Your friends at work, I think you're crazy. And then at 90 years old and you're visiting them in the nursing home, they may not think you're so crazy anymore. So, do some exercise. Never just sit there. All right, let's talk about the benefit of survivorship. We'll kind of start this. I think this is huge, but the life insurance doesn't, and I haven't been able to convince them. This is the product I was trying to get them to sell at UTSA. This is something only the life insurance industry can do. Other products can do it, but they're government products. They're not insurance industry products. And that is a product that the payment depends on when people die. Banks can't do that. If you die, the product continues, just goes to your beneficiaries. They don't stop paying. They don't take your money away. So you can figure out the benefit of survivorship by comparing a longevity product from a life insurance company to a regular bank certificate of deposit. Because a certificate of deposit doesn't care when you die. It pays the exact same amount either to you or to your beneficiaries, whether you live or die. It doesn't really matter. But an annuity only pays you if you're early, if you live. If you die early, you get nothing. And that's what we call a pure endowment. So if you buy a CD with interest of 5%, you're going to make 5% over 50. I'm doing 50 years to kind of exaggerate it. If you die in 3 years, the CDs goes to your family, and in 47 years, they get the money and they make 5%. So it doesn't matter whether you live or die, you make 5%. What if you do an annuity? If you do an annuity, if you die in 3 years, you lose 100%. You get nothing. But if you make it 50 years, I don't know why I'm dividing by L90, L50. Let's see if I understand this. 30-year pure endowment interest rate of 5%. Yeah, I'm not sure I'm mixing up 50 and 30 years, but anyway. So if you live, yeah, that's really, really strange. This says 30. So I think these are 30 years. So ignore the 50 years. I think that's a typo. So you're currently 60. And it's a 30-year zero a CD. So for 30 years, you would make 5% with the CD. Yeah, everything I'm using 30. Sorry, that 50 years is just a misnomer typo. So if you die in 30 years, what will you have? Well, here, you invest $60,000, I mean $10,000 at L60 at 1.05 to the 30th. That's what you invest, but the only people that are going to get it are the L90s. So you invest $10,000 times L60, all those people alive, invest it at 5% for 30 years. The L90s get it. So they invested 10,000 bucks, but they're going to each get 541,047. The people who didn't live, the L90, L60 minus the L90s, they get 0. So for the CD, you make 5% no matter what. For this product, if you live to make it to age 90, you made $541,000. You invested $10,000. You raised that to the 1/30th minus 1. You made 14.2% over 30 years. Where else? And this is guaranteed. Backed by a life insurance company and backed by the state of Texas. Where can you go in the United States or in the world and get a guaranteed government-backed 14.2% return for 30 years? Would any of y'all make that investment today? You could do it, 14.2% guaranteed. What's the only thing you have to do to get 14.2%? You only have to do one thing. Live. That's all you got to do is live. If you die, you're like, how worried about it if you die? How much are you going to worry about it once you die? You lost 100%. Are you going to be really upset about it? We don't really know, do we? Right? We don't know what it's like after you die. But so I can't help you. Well, I can give you my opinion on it, but I'll leave that out of this class. All right. That's the benefit of survivorship. What I want to convince you is that creates an incredible opportunity for life insurance industry to address the retirement catastrophe in this world is by creating these beneficial survivorship products. They have a product that can guarantee a 14% return for people who live. It's the only industry that can guarantee a 14.2% return. And I'll show you how you can use that in a really, really powerful way to actually do something quite powerful. All right, let's start there. Your papers are due next Wednesday, but has anyone turned theirs in yet? Anyone thinking they might turn it in like Sunday or Monday? So if you have it early, get it in there early. If you don't get them in early, you may not have them graded by the time you get back after Thanksgiving. So we will have class Tuesday night. If y'all want me to show you the example paper again Tuesday night, I can. But when you finish your paper, don't say, "Oh, it's not due till Wednesday." I might look at it. No, just turn it in. If you're traveling, doing Thanksgiving stuff on Wednesday, get it in early so I can start grading it.